Hello everyone. This video is about equity shares. Equity shares are the main source of finance of a firm. It is issued to the general public. Equity shareholders do not enjoy any preferential rights with regard to repayment of capital and dividend. They are entitled to residual income of the company, but they enjoy the right to control the affairs of the business, and all the shareholders collectively are the owners of the company. Equity shares are normally known as ordinary shares. They are also known as ownership shares. The holder of equity shares is a fractional owner who enjoys voting rights, shares in the profit, as well as claim over the assets of the company. Features of equity shares. Equity shareholders are the actual owners of the company and they bear the highest risk. Equity shares are considered as ownership shares because they are permanent in nature. Usually, owners have to bear the highest risk. Therefore, only those who are willing to take higher or greater amount of risk should go for investing in equity shares. Equity shares are transferable. That is, ownership of equity shares can be transferred with or without consideration to other person. Equity shares are permanent in nature. That doesn't mean they are not transferable. The owner of the equity share can easily transfer it to other people by selling it in the stock market. Dividend payable to equity shareholders is an appropriation of profit. Appropriation in general means setting aside money for specific purpose. Here appropriation results in transferring the profits to another account, whereby profits can be maintained in multiple accounts instead of a single account. Dividend payment under equity shares are not compulsory. Equity shareholders do not get fixed rate of dividend. Usually, preference shareholders get fixed rate of dividend, but equity share dividend is not fixed. When the profits are less, the company can decide not to pay any dividend on equity shares. If the company is earning higher profits, the sky is the limit for equity shareholders' dividend. Equity shareholders have the right to control the affairs of the company. As you know, equity shareholders enjoy voting rights. Whenever a decision is to be taken, the company should go for voting. Always, the decision of the one who holds majority equity shares becomes the decision of the company. Therefore, it is said that equity shareholders have the right to control the affairs of the company. The liability of the equity shareholders is limited to the extent of their investments. In case of sole proprietorship, the owner's liability is unlimited, but it is not applicable to the companies. The equity shareholders are the fractional owners, but their liability is not unlimited. Their liability is limited to the extent of their investments. These are the different features of equity shares. Types of equity shares. Types of equity issue. Equity shares are the main source of long-term finance of a joint stock company. It is issued by the company to the general public. Equity shares may be issued by a company in different ways. They are as follows. New issue. A company issues a prospectus inviting the general public to subscribe its shares. Generally, in case of new issues, money is collected by the company in more than one installment, known as allotment and calls. The prospectus contains details regarding the date of payment and amount of money payable on such allotment and calls. A company can offer to the public up to its authorized capital. Shares issued for the first time are called new issues. Equity shareholders. Equity shares can be issued by the company through issue of prospectus. Here prospectus are like invitation which consist of all the details regarding the new issue. The investors can buy these shares directly from the company. Usually the investors have to pay the money in installments. These installments are known as allotment money and calls in case of new issue. Bonus shares. In business, bonus shares are the shares issued free of cost by a company to its existing shareholders. As per Securities and Exchange Board of India guidelines, if a company has sufficient profits or reserves, it can issue bonus shares to the existing shareholders in proportion to their number of equity shares held out of accumulated profit reserves in order to capitalize the profits or reserves. Bonus shares can be issued only if the Articles of Association of the company permits it to do so. Bonus shares can be considered as additional shares issued free of cost to the existing shareholders of the company. It helps the company to increase the issued share capital, which gives a better image to the company, attracting more new investors. It also helps to make the shares more affordable because it decreases the stock price. But for issuing this bonus shares, the company needs permission in their Articles of Association. Rights issue. According to Section 81 of the Companies Act 1956, rights issue is the subsequent issue of shares by an existing company to its existing shareholders in proportion to their holdings. Rights shares can be issued by a company only if the Articles of Association of the company permits. Rights shares are generally offered to the existing shareholders at a price below the current market price, that is, at a concessional rates, and they have the option either to exercise the right to sell the right to another person. Issue of the rights shares is governed by the guidelines of Securities and Exchange Board of India and the central government. Rights issue gives the right to the existing shareholders to purchase the additional shares issued by the company at a concessional rate. Here the existing shareholders are having the rights, not the obligations. The shareholders can sell these securities to other investors. This rights issue also needs permission of Articles of Association of the company. The company should follow the guidelines of Securities and Exchange Board of India and central government while issuing rights securities. Sweat issue. According to Section 79A of Companies Act 1956, shares issued by a company to its employees or directors at a discount or for consideration other than cash are known as sweat issue. The purpose of sweat issue is to retain the intellectual property and know-how of the company. Sweat issue can be made if it is authorized in general meeting by special resolution. It is also governed by issue of Sweat Equity Regulation 2002 of the Securities and Exchange Board of India. Usually, startups prefer to issue sweat equity because they do not have adequate resources to compensate the employees for their hard work. At the same time, it is very important to retain the high quality human resource. By issuing these sweat equity, startups can retain these high quality human resources and compensate their hard work. The shares issued to their existing employees or directors to retain their hard work or know-how, it is called sweat issue. These are the 4 types of equity issues. New issue, issuing shares to the general public through prospectus. Bonus issue, issuing shares to the existing shareholders for free of cost. Rights issue, issuing shares to the existing shareholders at a concessional rate. They have the right to decide whether to buy it or not. Sweat issue, issuing shares to the employees as a compensation to their hard work. Advantages of equity shares from the shareholders' point of view. First one, equity shares are liquid in nature and can be sold easily in the capital market. Liquidity means the ability to convert the security into cash without wasting value or time. Equity shares are liquid in nature. It is beneficial to the investors. The dividend rate is higher for equity shareholders when the company earns higher profits. Dividends are not fixed for equity shares. If the company earns higher profits, the sky is the limit for investors of equity shares. The equity shareholders have the right to control the company's management. Equity shareholders have the voting rights. The opinions of equity shareholders always plays important role in the company's decision-making activities. The equity shareholders not only get the benefit of dividend, but they also get the benefit of price appreciation in the value of their investments. If the company is highly profitable, equity shareholders can get higher dividends. If the company is not paying dividend, the money will be accumulated and ultimately it leads to capital appreciation, which will benefit the shareholders in the long run. These are the advantages of equity shares to equity shareholders. Benefits to the company, that is from the company's point of view. Equity shares are the permanent source of capital for a company. By issuing equity shares, a company can raise large amount of capital. They are permanent in nature. It helps the company to meet their long-term requirements. There is no requirement of creating a charge over the assets of the company when equity shares are issued. Creating a charge means using certain assets as a security. If a company wants to borrow money from banks, they have to provide certain asset as security. But for raising money through issue of equity shares, the company does not need to provide any asset as security. It is beneficial for the company. The company does not have any obligation to pay dividend to the shareholders. Equity share dividends are not fixed. If the company does not have fund, or if the company wants to retain the money, they can avoid paying dividends to equity shareholders. The creditworthiness of the company increases among the investors and creditors when the company has larger equity capital base. If the company is able to repay all its debts, it can be called as creditworthy company. This creditworthy status of the company attracts more investors and lenders because the company is trustworthy. Large equity base helps the company to gain this creditworthy status. These are the benefits of the equity shares to the company. Disadvantages of equity shares. If only equity shares are issued, the company cannot take advantage of trading on equity. Using the debt security such as debentures, bonds, etc. to acquire new assets and generate higher return is called trading on equity. If the company is issuing only equity shares, they cannot take advantage of this trading on equity because they don't have any debt securities. As equity capital cannot be redeemed, there is a danger of overcapitalization. Overcapitalization, it is a situation where The actual profits of the company are not sufficient to pay interest and dividends to their investors. Since equity shares are permanent in nature, excess issue of equity shares can lead to over-capitalization. Equity shareholders can put obstacle for management by manipulation and organizing themselves. Since equity shareholders have the voting rights, they can involve themselves in management related activities. It can become problematic for the company. Investors who desire to invest in safe securities with a fixed income have no attraction for such shares. Equity shares are considered as risky investment avenues. Risk-averse investors may not prefer to invest in these type of shares, that is equity shares. These are the disadvantages of equity shares, and it is all about the meaning, features, types of issue and advantages and disadvantages of equity shares. Thank you.